I'm Nick Grove for Morningstar.com.au, and today I'm joined by Morningstar's David Ellis, who's here to discuss the most recent batch of earnings from the big banks. David, welcome.
Thanks, Nick.
First of all, David, this week we saw Westpac release its half-year results, which you described as slightly disappointing. Could you just elaborate on a few of the disappointing aspects?
Yeah, sure, Nick. Yeah, well, the bottom line profit was flat on a year ago. That was, I suppose, the biggest disappointment. We did see good volume growth, so lending growth was good and deposit growth was good. Margins, net interest margins were a little bit soft. But I suppose the biggest disappointing thing was that expenses were higher than expected. So profit growth was, as I said, was flat. Dividend was up only 1 cent per share. I think the market was expecting, and I was expecting, a stronger result in profit and dividend. So that's why I was a little bit disappointed with Westpac's result.
Next up we had ANZ, whose result you said was respectable. Was it respectable across the board, or were there some disappointments?
Yeah, well, there was some disappointments. It met expectations. It was a little bit above what we were expecting. Not much, but a little bit. The biggest disappointment was net interest margins continued to decline, but for ANZ. That's not a major problem, because they've been experiencing over the last few years a change in the mix of their business. So a lot more of their Asian business is at lower margin, but the compensating upside is that their non-interest income was a lot higher to offset the decline in net interest margins. But overall, it was a pretty good result. I suppose the biggest thing to come out of the ANZ announcement was the CEO Mike Smith's confirmation that he didn't believe the bank needed significant amounts of extra capital right now, and that when those regulatory requirements are clarified, he believes that ANZ's in a strong position to raise capital in the future if required.
David, NAB's capital raising to fund its UK asset demerger overshadowed its half-year result, but were you pleased with its earnings, and is the pain in the UK finally over for NAB?
Yeah, the NAB result was a very complex set of announcements. There was a lot of big issues that were covered in the result. The 5.5 billion capital raising was a surprise. Approximately 3.3 billion Australian dollars of that is required to support the demerger of the UK banking businesses. There's still a lot of regulatory approvals required for that demerger, but let's assume that happens. NAB expects that to complete by the end of this calendar year, which will be a very good outcome. And to answer your third part of that question, if the demerger goes ahead as expected or as outlined yesterday, well then yes, it will be a very important development for NAB. But there are some issues in the UK, mispricing and conduct issues, that even after the demerger could impact future earnings or future results for National Australia Bank. So it's not clear cut. It'll take a number of years to finally resolve. As far as the underlying result, the Australian and New Zealand operations for National Australia Bank were good, pretty good, sort of in line or maybe even a touch better than expected. Good performance in volume, so good loan growth, good deposit growth in the retail banking, so in home loans and customer deposits. And pleasingly, we're seeing NAB's business loans. So NAB's got the biggest market share in the business segment in Australia. So pleasingly, we're seeing some recovery there in that business. So that was a good sign, and we expect to see stronger performances in the Australian and New Zealand businesses going forward.
Finally, David, the market didn't seem too impressed with CBA's below forecast third quarter result, even though it apparently made $1 million an hour. But did you take some positives away from this result?
Well, yes. I mean, obviously, As far as making $1 million an hour, the Commonwealth Bank, of course, is the largest bank in Australia. It's got the biggest market share in home loans and in household deposits and credit cards, and it's got quite a large wealth management business. So it doesn't surprise me that it's generating those sorts of profit metrics. The disappointment for Commonwealth Bank, and this was of course only a trading update, and trading updates can be volatile, are volatile. You shouldn't read too much into them. But the disappointments was the acknowledgement that net interest margins continued to be under pressure, and that cost growth was higher than expected. This is a turnaround from the first half. Commonwealth Bank reported a very, very strong first half result in February, and their cost to income ratio was a very good outcome. It continued to decline in the first half. But the trading update suggests that's reversed. So we'll just have to wait and see until the full year results are announced in August this year. But the market didn't like the update, and of course the stock got smashed on the day. I think it was an overreaction, share price overreaction. The underlying profit powerhouse, which is the Commonwealth Bank's retail and business banking businesses, it will continue to churn out profits into the foreseeable future.
David, thanks very much for your time today.
Pleasure, Nick.